He's been positioned correctly. I mean, you guys know of his mega cap positioning, and it has worked in a big way. So, Brad, you welcome back. It's great to see you. You just heard Weiss lay out the reasons why he's rather bearish, sitting right next to you. What would you say to that perspective, and how does it sort of mesh with your view?
Well, first, let me just say it's great to be back at Milken. We're in theater in the round, people all around us. I remember, Scott, when we were first together here in the fall of 21, it was pretty empty. We're in the middle of COVID, and you and I had a really important interview on that day. You asked me what I thought was going to happen to the market. And remember, we had this asset price bubble. Rates were at zero. And I said, I think COVID is over. I think the world is normalizing. And we're going to go back to January 2020 levels on the 10-year, which meant that multiples had to retrace in technology by about 30%. And I said, if that happens, it's going to feel catastrophic, even though it will only be normalization. And that's exactly what we got. 22 was a tech recession because of that normalization process. And thanks for the shout out about Q1. But keeping it real, 22 was our worst year. 22 was a big challenge for a lot of tech investors, even those of us who had on hedges, because everything went down. And now we see it rolling through, at first the banking system, soon to come, commercial real estate. And where I agree with Weiss is there's still a lot of uncertainty in the system. But we had Wilson at the start of the year for Morgan Stanley. That was the consensus in the market, that the S&P was going to go to 3,000, 3,300, that we were going to have an earnings recession in Q1, that inflation was going to stay hot, rates were going to have to go higher, and we didn't get that. I thought we had a regime change at the start of last year. This is no longer about inflation higher and rates higher. This is now about inflation lower, and rates will peak in May or June of this year, and then they'll likely follow as well. We think that setup, coupled with the rationalized multiples of tech stocks, made it a great time to start investing in companies like Meta, like NVIDIA, like Microsoft, that we expected to beat earnings, and they delivered.
You tweeted a few weeks ago, quote, clear that the higher inflation, higher rates playbook that crushed long-duration tech stocks is largely behind us. Does that tell you that this run that we've seen in large-cap tech is likely to continue? And are you, in some respects, even surprised by the degree at which those stocks have gone up, which have clearly helped out your own performance, obviously? But generally speaking, I mean, they've really led this rally.
Well, to be honest, what I was surprised by is the parabolic rate hikes of 22. Inflation, frankly, was hotter for longer than we expected, and the multiples on these stocks got crushed even more than I expected. I think Meta at its trough was 7 or 8 times earnings. So, when you look at the other side, Meta, of course, has doubled this year, but at 18 times, so the market multiple, 18 times next year's earnings get you somewhere $320 to $360. That's just one stock in tech. So we think that this regime change is behind us, that now we're going to, inflation's going to move lower, that rates are stabilizing, and in that environment, it's a good environment for technology. Now, when it comes to other parts of the market, we still have a lot of other parts of the market that are priced at peak multiples on peak earnings. And we think there is going to be damage to come in things like commercial real estate. So one of the things that's our theme at Altimeter is just dispersion. Remember, in 2020, everything was up because we had an asset price bubble fueled by 0% rates. In 2022, it was all tech down. This year, it's good earners go up. The companies that get fit go up. The companies that are driving free cash flow go up. But the companies that are on the wrong side of those trends and trajectories are going down, which makes it a good time for long, short public funds.